So would it typically be safe to assume that the larger the investment price is, typically the less risk? Like, I know that.
No.
In business, I know that it's quite clear if you're going to buy a $10,000 to $20,000, what they would call a business, I call a startup. There's so much more risk in that versus if you're going to buy something for $200,000 or up to $500,000 for a business. Then typically the more established assets, the less risk. So it's not the same with commercial.
It is to a certain price point, right?
And what's that price point? That's what I'm trying to draw out of you.
Try and draw out of me.
Yeah.
Well,
and we won't hold you accountable to it.
It's not really a price point. It comes down to the deal itself. So if you could have a commercial property which is highly attractive. You got a really good tenant in place, like say it's a pet barn or something. That pet barn, if they get up and leave, then you've got a massive commercial premise which only fits a select number of business
tenants.
Yeah. So then you got to be able to carry that loss carrying forward. You'll obviously rent it out eventually, but that's where the importance of location research in the commercial space is really important as well, because you want to be de-risking that as much as possible.
What do you mean by that? Like,
well, you don't want to buy a commercial.
Like, so you're also looking for capital growth as well by getting the right location. Is that what you mean by de-risking there? Or
well, by getting the right location, you do get better capital growth, but also it's if that tenant does vacate, that there's a number of tenants in that vicinity that could potentially lease that property from you as well.
Got you.
If you're buying in places that are further out of a dense population, then you're reducing the level of businesses that are surrounding it. So therefore, you're reducing the potential of tenants occupying that property from you. Mm-hmm. And then you go further into like the infrastructure is a great one to track with commercial, because businesses need warehouses and office space to operate a business in that region. So looking into that, it's always good to keep your finger on the pulse. Like at the moment, areas of, say, Gladstone are booming, and there's a lot of infrastructure and businesses investment going into that region. Yes, it's a strong mining town, but there's also a lot more going on in regards to the local councils putting in a lot more infrastructure to expand that region. A lot more businesses are going in there because there's a lot of growth in the renewable space, and that's kind of why it's quite attractive. With those more businesses coming in, you're de-risking it from that point of view. But once again, if you're going into that's like $3 million plus, those bigger assets, you're really delving into the lease agreement, because you can pay off a commercial property in 10 years, right? Mm-hmm. If you've got a 10-year lease, then you're de-risking it every single year because that person's renting it from you. You're paying down the debt.
Yeah.
You might get to a point where they have a lease renewal, but you've got really low debt on that property, so you can wait out longer for a new tenant because
it's not going to cost you too much.
Yep.
Yeah. Wait for a longer tenant, which will actually boost the value of the property when you want to sell it, if you do sell it.
Yeah, there's strategies in commercial too where you find those properties that have poor lease agreements in place, and if you can strengthen them, then it's a more attractive tenant, therefore lower risk, and therefore the capitalisation rate that the value will use is lower, so it gives you a higher value. There's a bit of a mouthful of that.
No, so like breaking that down is like people can buy a commercial deal that's got like not the most favourable lease agreement, and they could change that to get a better lease agreement, a longer term lease agreement, which will add value to the property, and then they could flip it. Right? That's just their cash grab in how they can work. Right?
Yeah, you've got a different hat on too. You get creative. You can buy a large industrial freestanding property. And if you can have the ability to put some dividing walls in, you can split the tenancies up. You're de-risking it by having 4 tenants, not one. Mm-hmm. But that requires additional capital, right? So this is where every individual circumstance is different. and it's like you can make some really good money, but it's like anything. You can make good money in like a residential development, but
Yeah.
depends on the level of cash you've got.